Hello, everyone, and welcome to Undergrads Invest. Undergrads Invest is a platform for undergraduate investors to share their investment ideas with the world. If you enjoy the podcast, make sure to leave a 5-star review or follow or subscribe on whatever platform you're listening on. Just a reminder, nothing we say on this podcast is investment advice. We are, in fact, not financial advisors, so make sure you do your own due diligence. With that being said, I'm super excited to welcome our guests for the day. They are a team from BCG Undergraduate Investment Fund at the University of Houston. I met these guys a couple of weeks ago doing a stock pitch competition, heard their pitch, loved it, loved the thesis. I wanted to have them on the podcast to sort of share that with everyone. So if you guys just sort of want to go around and introduce yourselves before we start, that'd be awesome.
You go ahead, Obi.
All right. My name is Avi. I'm a sophomore, and then I'll let everyone else go.
Yeah, so my name's Hasnain. I'm currently a sophomore at and I'm studying finance.
My name is Carson. I'm also a sophomore studying finance and supply chain management, and it's my first semester in BCG, so excited to be here.
I'm Devin. I'm also a freshman studying finance, and this is also my first semester.
Awesome, guys. Well, if you guys just want to jump on into it, I'm excited to learn more about energy fuels.
Sure. We had a price target of $14.90. We kind of reduced the price target to make it seem okay for the competition. Realistically, we believe like this is kind of I wouldn't say risky, but it's definitely a speculative play.
Gotcha.
If it works out, it's more like 4 or 5 times upside more than 100. But again, this doesn't make sense to bring a 4 or 5 times upside pitch to a competition. We have a pretty lengthy timeline. It's more about you'll see as we get into the pitch, but it's more about, are they able to execute on this plan they have? The plan's great. They have a competitive advantage. They have a moat, whatever, but can they execute over the next 5-6 years? If they can, you kind of see that multi-bagger upside. If you can't, well, they still have uranium assets, which we'll go into. Yeah. Next slide.
Awesome.
All right. Yeah. So just kind of starting off, so for the first however many years of the firm's operating history, they've always been a uranium producer. Only recently they've started to expand into the rare earth elements sort of industry. Mm-hmm. As you can see here, they have their 4 major operating assets. So you have the White Mesa Mill in Utah, which is going to be drilled into you guys' head throughout this entire session. And that's their only operating and producing asset at this point in time. But their other major assets that they wholly own are the Pinyon Plain Mine in Arizona, and the Nichols Ranch ISR in Wyoming. And just a key thing to touch on that actually happened pretty recently, and it kind of not threw us for a loop during the stock pitch competition, but it was a pretty unforeseen event, was that they actually sold one of their major assets, which was the Alta Mesa ISR in Texas.
And what do we have that valued at? We had that valued at like something really low, like 10-20 million. It sold for 120 or something.
Oh, wow.
Yeah.
Could you maybe touch on the difference between what White Mesa is doing versus the other 2 on standby? Whether it be their mining or processing, and then sort of why White Mesa is producing and then the other 2 are just on standby.
So the reason that White Mesa is operating is because it's their biggest and it's their most, I guess, historically successful. And it also holds, so right now, their revenue is kind of split in a very small scale between uranium and vanadium. Gotcha. Vanadium is another element. And essentially that asset is sort of the operating base for the entire firm for literally everything that it does. And so that's kind of the reason why it's still operating. Also the high reactivation costs for uranium mines. So that's why you see Pinyon Plain Mine in Arizona and Nichols Ranch ISR in Wyoming being on standby, is because the cost to, I guess, resume operations is pretty substantial, especially for a company that's looking to put as much cash into its new rare earth business as possible. So I think, to answer your question, the reason that those 2 are on standby is simply because they don't have the risk appetite to reactivate those mines in this current uranium market, especially as they're looking to develop their rare earth material business.
And also like two other things. On White Mesa, they're really good at uranium recycling. That's kind of the right now you get production kind of happens with these bigger plays, or at least in America for utility or for developers. You can either contract it out to a utility for a set amount of period. You get your production online for that amount of set period, and you give them production. Or second thing is you can take on these nuclear waste recovery projects, which no one people are going to pay you to handle for them because they can't really handle nuclear waste. And then these guys at White Mesa are able to go into that, make it deal with the radioactivity and also take some uranium out of there to hold in storage or whatever. So that's kind of why White Mesa is the best at recycling, which is kind of the biggest thing that can do right now with the uranium market, how it is. And the second is the other two are really not going to come online unless they sign enough contracts with utilities to where they need the production, because they already have a lot of uranium instead, on reserves. I think it's 800,000, 900,000 pounds. So unless it's drying up, there's really no need to produce just to produce and say you're producing.
Yeah. So Pinion and Nichols are more on the mining side, and then you have White Mesa who's actually doing the processing and the recycling.
Right.
Gotcha.
And they're licensed. They're the only licensed operation in the US. So
gotcha. To actually do that recycling, they're the only one in the entire United States, the only ones who can do that. Gotcha. Makes sense.
Alrighty, we good?
Yeah, that makes sense.
Alrighty. Actually, before we move on, just a quick note: the Alta Mesa ISR sale management in the notes on the website indicated specifically that sale was entirely to fund the rare earth material business. So it kind of just, the fact that it happened recently just kind of speaks to management's focus on rare earths as the future of the firm.
Man, I mean, if that had $120 million valuation, I would be interested to see what White Mesa's valuation would be all on its own, just as an asset.
Yeah, it's
probably more than a company.
Yeah, that's what I was thinking.
Yeah. So moving on to the supply side of the uranium market itself. As you can see from the first chart, Kazakhstan has a hold on the entire uranium supply market. It's almost 50%, which is quite a bit. That's primarily just due to the cost of production, as well as sort of their geographic location, being in the middle of literally so many centers of population in the world within Asia and Europe. And yeah, so ultimately, as a uranium producer, Energy Fuels kind of would benefit from supply constraints that we see forming, particularly in 2022. There's a 65 million pound expected deficit between uranium production and demand of uranium. And at current, rates, this is expected to grow to 100 million pounds. And primarily, this is just because for, a good long while, almost a decade, uranium miners haven't really invested and put the capex into developing new assets that they should. And because of this, you're seeing a lot of mine depletion as uranium producers have sort of relied on depleting these mines as opposed to, as I said, putting more money in developing new producing assets. And ultimately,
is that in part due to the current spot price is at $55, and that's really, if I'm correct, above average over the past 10 years. So there's just been an issue with these mines being able to be online just because of that current spot price. I guess my question is then, where do you see, uranium prices going in the future for mines to be able to go back online, particularly Energy Fuels? And do you know what Kazakhstan's mines break even prices relative to Energy Fuels maybe?
Yeah, so the biggest thing is to understand this kind of how the market developed after the incident in Japan. A lot of reactors got shut down. There's a lot of excess supply, especially in the spot markets. So what happened was contracting slowed down, right? Because it's the whole idea about uranium contracting, and the reason why utilities pay above average prices for contracting is because it's a market based on availability, not really price. If you think about how much energy you can get from 1 pound of uranium, or also the cost of shutting down a facility because you don't have enough input feed, that's very minimal compared to that stuff. So it's they don't really care. If utilities have to pay $100, it doesn't really matter too much to them. It's more about is there enough supply available where we can risk not contracting or not? Does that make sense? So they've been doing it the last decade. The spot market's been so plentiful after the incident in Japan, is that they've been saying, I don't really need a contract. There's so much supply on the spot market. We can just buy as a spot. We don't need to contract out with people like Energy Fuels. And that's basically like, if you think about it from perspective of a uranium miner, why would you just, why are you increasing production if no one's contracting it out for you? You're not just going to add it to the spot market just to add to the spot market.
Yeah.
So in terms of spot price, yeah, it's 55. Average for like last 10 years around 30. Maybe I don't know exactly, but it's lower than now. Spot price has been moving mostly because the spot trust. We didn't get into a lot of this stuff, even though
Yeah, maybe we're a bit too early.
But the spot price is gonna move. I mean, Cameco basically said that they're not really gonna increase production significantly until it hits 80.
Okay.
And they're the big guys in the industry, so generally people follow them. I'm sure some of the small guys are gonna get like greedy and start production earlier. But Energy Fuels already did, for example. But I would say for the big supplies to come online, 80 break even, and these
Gotcha.
spot prices move really quickly. So it's like, it's not like if you're aiming for 80, it's gonna hit 80. It's gonna overshoot by a decent bit, and you're not gonna see demand destruction. Again, it's about availability.
Gotcha. And then I guess I don't know if you guys talk about on the next slide, maybe some like demand drivers for uranium. But I don't want to get too far ahead though.
Yeah, that's the next slide.
Awesome.
We didn't get to
Perfect.
talk about uranium as much as we wanted to in the pitch,
Yeah.
just because we didn't have enough time. But I think the uranium aspect is really cool. I don't think they understood that well, but yeah, of course.
Yeah. So flipping over to the demand side, like y'all said, primarily demand is coming from utilities. And then, you know, as nuclear energy power plants are reactivating and seeing sort of a resurgence and a renaissance, if you will, in recent months. But there's also demand from, you know, uranium trusts such as Sprott, you know, buying up uranium to improve their reserves to ultimately sell at a later date. But for the purpose of the demand, it's utilities. You know, you have places like Japan and India, and then even, you know, resurgence in European countries like Germany, France, I think is one of the only European countries that has continuously done nuclear, but that's only expected to grow. But you know, flipping over sort of to the long-term sort of side of demand, like Abhi was touching on with the contracts, a lot of reactor demand as we're going through, you know, the coming years is not contracted out, which is super critical. Because like you said, you know, availability is the name of the game here. And contracts, of course, reduce the risk on it in that sense. So yeah, essentially we see the long-term contract market heating up. Energy Fuels itself has signed 3 new long-term contracts in recent months with American utility providers. And that's sort of a similar sentiment as you go throughout other uranium producers in the country. And what this is indicative of, we hope, is that, you know, the nuclear reactors in America are starting to reactivate. They're looking to contract and get a steady supply of uranium from American producers, and ultimately, you know, buy more. And that's, of course, that's beneficial to a uranium producer like Energy Fuels.
And I think the important thing to note here is just the government. We kind of picked a company that was in the middle after Russia, what happened, like the Russian invasion, what kind of happened is governments are reevaluating maybe geopolitical dependence on other people. We kind of picked a company that is in the middle of 2 trends, both in the uranium market and the rare earth market. Basically, the US is kind of saying, are we going to rely on these countries for really, really important things like uranium, like both for defense purposes or even like for like energy purposes? So over the last kind of few months, they wanted to start a US uranium reserve, which is pretty significant. It was like, I don't know exactly the numbers, but it's 4.3 billion. There you go. That's really significant because uranium is not that big of a market, maybe 400 or 500 million in terms of public market. 400 billion, 400 billion. So it's like not huge, especially if you're looking at the US part of that. And going back to Kazakhstan they had some issues last year in terms of politics. They had some strikes and stuff. So it's kind of like, do you want to rely on them with, you know, them being so influenced by Russia and China? And
Mhm.
B, are they even going to be stable enough to continue production? What if some stuff happens in that country where, there's rioting or some type of conflict that prevents production to happen? So you can't let, you can't let your reactor shut down. You got to have your own reserve. So that's kind of what's happening. So you're kind of seeing that government aid is going to help this industry a lot. And because Energy Fuels is like completely America, like domestic, and it's, long history, been a historical counterparty for a lot of these utilities, they're going to be preferred over a lot of the other guys in the industry.
Yeah, I mean, that makes a lot of sense, maybe domestically, and especially since you guys said at the beginning they're the only ones who have the license in the US for like recycling or processing.
Yeah.
That seems like a pretty strong competitive advantage there, especially as everyone moves domestically. So that makes a whole lot of sense.
Alrighty. So now we'll flip over to the rare earth side. Like I've said already, the focus now for the future is, of course, moving in and expanding into the rare earth material industry. So I'll let Devin explain how that's happening.
Awesome. And their rare earth entrance kind of started like 2020, I think I saw. So like very recent, right?
Yeah.
Okay.
Yeah.
Yeah, so this slide just goes over demand for the rare earths. So like rare earths are used in permanent magnets, which are used in like EVs. Like a standard car uses 4 pounds, EVs use more. Wind turbines, which use 300 pounds. F-35 fighters, which use 1,000 pounds. Actually, it's used a lot in defense. I think we used 153,000 just for F-35s, and we'll use 435,000 pounds over the next 4 years. And that's just with Lockheed. And then
Christ.
3,000 get built every year. So demand is there for rare. It's just kind of in the name. They're rare, so and
Fair enough.
Not that rare.
and then there's 17 elements. There's like two neodymium and praseodymium are like the two main elements that make these permanent magnets, which we'll see in another slide, the yield for the sand for NdPrs, comparatively, that. But yeah, so this one just goes over how like China dominates the rare earth business right now. So like in all the pie charts, the dark blue is China, like 87% of processing is done by China, 60% of mining. And so like this gives the US an incentive to diversify its supply chain, right? You don't want to be dependent on China. And so on the right, it's kind of listed what's happening. Like there's congressional bills to ban defense contractors from buying Chinese rare earths. There's like Abhi said, the congressional bill to build a stockpile. There's in the USICA bill a plan to like promote funding for US rare earth development. And so these are all things that are just going to go into kind of bringing the supply chain back to the US and making us more independent.
Gotcha. I'm not sure if you guys know the answer to this question, but I saw that both, I think MP Materials and I think they're called Linus actually did get subsidies from the government.
Yeah.
But I don't think Energy Fuels did. Do you guys know why perhaps that's the case?
Yeah. So the one thing that Linus got was for a Texas facility. It's still under review. And I think one of the biggest reasons it's under review is because it's an Australian company. And obviously the government's going to vet a little harder than a domestic company. I mean, the answer to that one, just because they're 4 years earlier into the market, they have like the biggest thing if you're looking for government subsidies is they have proven production. So I think that's kind of the biggest thing there is just they had proven production. These guys are a little bit later. And then we basically think that once they start proving out production, like next 2-3 years, they're going to start getting that funding as well.
That makes sense.
As you'll see later, they just don't have the same capital expenditure requirements as the other two do because they have that white mesa asset.
Gotcha. And I guess maybe the government at this point, like you said, mainly sees them as a uranium company, the markets as well. So, okay.
Yeah,
that makes sense.
it's also just that like you wouldn't expect the government to invest into like this is speculative. This is like as much as we're trying to present that this is going to guarantee to happen, it's relatively speculative in terms of the biggest question is can they increase production? Government maybe wants to see, at least they can do the first 2 steps before we help them build out the later steps.
Gotcha.
Ready.
Yeah, so this slide is and this is a really crucial slide actually. It goes over the type of sand that Energy Fuels uses versus what majority of other producers use. So that's bastnasite is what other producers use. Monazite is what Energy Fuels uses. And so monazite is reactive, right? It has uranium and thorium, which are reactive. And Energy Fuels can handle the radioactivity because they have uranium assets that have the infrastructure to handle, the radioactivity in monazite. And the yields in monazite for things like the NdPrs, which I talked about earlier, the neodymium and praseodymium, are higher. The total rare earth oxide, which is trio, is higher. And like it all just kind of ties into the basket value being 21,000 as opposed to bastnasite, which is 8,000. So they can, make more per ton of processed sand in comparison to other producers.
Okay, got you. That was my question. So the value of a basket is like the value of a ton of that sand.
Yeah, well, it's the value of the rare earths in a ton of that sand. Like, yeah.
Gotcha. Yeah, so I guess just to reiterate then, that means Energy Fuels is like the only company in the United States because of White Mesa that is able to process monazite while everyone else has to process bastnasite. So they just essentially have an advantage right there. Okay, but yeah, I love that. Do the yields in like the monazite, is that sort of like a range? So you say an NdPr yield is 22.1%. Is that sort of a range? Because I remember actually we'll get into this when we talk about the Brazil project, but there's a certain range that those sands can actually have.
I think this is like, if I remember correctly, these are the numbers that we pulled from a earlier investor presentation where it's just like a regular basket of monazite just generally. I think for them, the ones they're able to process currently, basket value is around 18,000. The TREO yield is around 53,000 or 53%, sorry.
Mhm.
So I'm guessing it's around those numbers, just maybe not exactly. I think the biggest thing like to notice, we didn't have time to go over this obviously, but if you look at that heavies, the heavy percentage, the difference in the yield, MP Materials and Energy Fuels both want to build out like a heavy, like heavies sell for a lot more, so they kind of want to build out the processing for that. The question for MP is just many people just don't think they can do it because their yield is so low. The amount they'd have to process to be able to like build out a facility like that would be ridiculous. Versus Energy Fuels wouldn't need that even close to that level of. They're getting 13 times, 14 times the yield, right? So to be able to build out that valuable heavy processing, you don't really need as much production to justify it, if that makes sense.
Yeah. So if since MP was going after the heavies, is Energy Fuels, are they focusing, from what my thought was that they're going after the NdPr because they have the highest value. Do heavies have like a similar value and they're going after those just as much?
So there's two types of processing, like there's a light track and a heavy track that you can take. Those are the two types of processing you can do. NdPr is just kind of like a different it's a subsect of both, if that makes sense.
Okay.
So you could either have a light processing track or a heavy processing track.
Yeah.
And right now Energy Fuels, I think light is like 2026. So it's like really far in the future, and then heavy is going to be even farther than that. But just when we get there, Energy Fuels will actually be able to justify having that track and be able to like produce a significant amount to actually make a lot of money, versus MP probably not.
That makes sense. I mean, like you said, that's like a 13x yield right there between the sands. So okay. Yeah, I think that's good.
Yeah, so this is basically emphasizing the rare earth metal supply chain that Energy Fuels currently has in place. So as Devin said, the difference between monazite and bastnasite sand in the value of the basket is pretty tremendous. And it has a lot to do with how they process the sand, right? So in step one, what Energy Fuels does is we currently have an external supplier of our sand, which is Chemours. Chemours is a chemicals company. We get the sand from the titanium mining operations in Georgia, in southern Georgia. And this is where they supply our sand from in step one. And from that sand, we mine the ore from the sand. Okay. In step two, we take that ore and we refine the ore into the Re carbonate. What that means is we're taking all the unwanted stuff out of the ore. And then in step three, we're getting to the rare earth elements we actually want. And as Devin said, there's 17 rare earth elements that are important all across the world, and we're trying to separate these REEs or rare earth elements into these 17 different baskets. And steps 4 and 5 and steps 2 and 3 are currently done in-house at the White Mesa Mill. As Abhi and Carson said, it's the only operational and licensed facility in the US. In step 4 and 5, we are actually using an external provider for refining these. So this is the downstream part of the supply chain. We're refining these rare earth elements into alloys, metals, and NdPrs, or the neodymium the magnets, the permanent magnets, and we are using neo-performance materials as an external supplier. So that's basically just an overview of how it starts from the input of sand all the way down to the refining of end products.
Gotcha. That's good. I think that makes complete sense.
Right.
Now, this is part of our thesis and is very important to the trajectory and the long-term future of energy fuels, and that's its integration plans, right? So in step 1, management had indicated that they want to diversify its sand input, right? Currently, they only use Chemours as an external sand provider. And
could you maybe touch on why Chemours is the only like supplier they have? Because they're using it as sort of it's a byproduct of, you said titanium mining. Why aren't there other like titanium miners or anything that are giving these sands to energy fuels?
So the problem with us using Chemours, and primarily this is a reason why we want to diversify its sand input, is primarily because Chemours has the largest titanium mining operation in the US, and they can provide us the volume and the tons of sand we need to process these rare earth elements. I'm not sure if they are the largest, but they're one of the largest titanium mining.
Also, to add on, like the question there is, we don't know. I mean, management.
Fair enough.
Management's kind of indicated that they wanted to sign some of these external contracts with other people. It's not like Monazite is just like, it's not like it's rare or anything. They should is kind of the thing I'm getting at. But also last year, like Myanmar is the biggest source of Monazite, especially to China. And they had some problems last year, in 2021 actually, but also seeped into last year with like, I think flooding or something had to do that.
Okay.
Like really reduced. I'm not sure if it was something, but it was like something that really reduced the amount of Monazite sand that was available. So what happened was China ended up bidding on project, like they ended up, instead of just relying on like Myanmar, they had to go out and buy from other places. Like they were targeting the same places that Energy Fuels was probably, and Energy Fuels probably didn't want to be like, okay, we can pay like 30-40% higher prices for the sand, or we could just prove out production and then wait like a year or two, and then we can just pay normal prices. Like it's not like they were going to make that much money anyway if they added like 2,000-3,000 extra tons, So it's like,
gotcha.
maybe not the best short term in terms of investors are wondering why you're not signing these contracts. But long term, like I don't know what's the point of rushing the process kind of thing. Like you can always increase capacity once you prove out production. And like 2022, yes, production numbers were bad, but what they were able to prove is that they could do it. Like they could actually do this theoretical thing they're put into practice.
Yeah, I mean that makes sense. So I guess the thought is that they may be getting beat out by international processors. Other companies domestically may be taking that monazite and just sending it off to some other international person who can do it cheaper than White Mesa.
I also think the long-term play is, we talk about Bahia Project a lot, but I mean, long-term is just not going to be enough. You got to have Bahia, you got to have external contracts like Chemours, and you got to buy out the spot.
Yeah.
So it's just, they're going to have to do it. Just like, management just has to do it.
So moving on to step 2 is refine the ore. This is currently also done at White Mesa. So this part of the integration plans is already part of the, it's already done. Step 3, the separation facilities. The first like broad scale separations are already underway at White Mesa, and they will build an extra, they will require further capex for the separation facility in the future, which I'll touch on later. But in steps 4 to 5, they hired Kerster as a consultant for the analysis of an integrated facility at White Mesa. So, and they estimate that a total build out will be around $250 million for a final build out. And yeah, that's primarily what management has indicated. And as Carson said, they're trying to use as much cash flow they get from the uranium operations to try and fund a new growth engine in the rare earth metals business.
Is that
Yeah.
maybe why they sold the Alta Mesa too? I actually think you touched
Yeah.
on it. It's to pay that 250 million.
That's exactly, yeah.
Yeah.
But
Line.
also step like this is like very, very far in the future.
Right.
Like step 3, that light and heavy track I was talking about, that's like 2026, 2027 is when they're going to start production on that or start building that out. And that's just step 3. So it's like we're talking about 2030 plus for this the total capex. Again, very far in the future, outside of our thesis, like time horizon, whatever. But at the end of the day, it's like whoever has like they're behind their competitors now. I don't know if they're going to be behind their competitors at step 4 and 5 is kind of where I'm going with that.
Fair enough. But then also to add on to that, their competitors aren't using monazite, right? So I guess even in that one is
Linus is
gotcha. And they're doing it in Australia.
yeah, and they have
Gotcha.
one problem that we'll get to in the competitive slide.
Gotcha.
Oh, sorry, this is my slide. Basically here it's like, all right, so kind of what we've been talking about the whole time. Can they prove out production? Like what they've been able to do the last year is they've been able to say we can do steps 2. Like it's not theoretical. We can actually do like we can produce it. We can produce the carbonite. We can separate maybe in some lab scale capacity. So now it's kind of can they actually increase their production? And then it goes back to just the amount of sand they can like the sand input they can get because it's not a capacity issue, right? Like 2 to 4% of white mesa is like 30,000 tons, which is 30 times what they currently produce. So it's like it's not a capacity issue. It's not a process issue. It's an issue of can they get input feed, and generally your input feed should be. It's an important part of the process, but it shouldn't be what's determining your valuation. If that makes sense.
Yeah.
So kind of what they've kind of like their solution to this sand input feed issues that they've been having is the Bahia Project, which is like 17 mineral concessions in Brazil's Bahia region, expected to provide them with like 10,000 tons of sand, like best case scenario, a year. So again, 10 times current levels, but long term, it's just not going to be enough. But it's definitely going to help valuations a lot because with that 10,000, they're going to basically hit like 1/2 production of their competitors, which is pretty decent because they're making a lot more than the competitors margin wise. So yeah, is there any questions on that? That's like we can talk about timeline a little bit.
Yeah, I guess what I didn't realize going through is that that's only 1.5 to 5 tons annually. I mean, white mesa's capacity, I mean, if 2% is 30,000, I mean, that's absurd. Why is their capacity so high? Did they just like why did they decide to probably spend a lot of capex to, I mean, have absurd capacity that they can't fill?
Oh no, it's just because white mesa isn't like an asset built for rare earths, it's an asset built for uranium.
And it
Right.
just happens to be able to do both.
Yeah.
Gotcha.
I mean, in the monazite process, you're like step 2, you're literally just taking uranium out of that sand.
Gotcha.
Taking thorium out of that sand. It's the same thing they've been doing. In fact, the monazite sand is 0.2% yield of uranium. Their historical feed, so like what they usually use to take do the uranium operations is 0.13. So the sand is
Okay.
basically just a more uranium filled or a more radioactive filled sand than what they traditionally use to get their uranium.
So is this going to replace this isn't replacing their current sources of uranium, right? So they're going to
No,
have,
it's not going to replace it, but it's going to be a decent amount. Like we have it in our model, but basically it's gonna allow them to, like, just as a byproduct of the rare earths, they're going to be able to generate a significant amount of uranium production as well.
gotcha.
And none like Linus is using monazite, but they can't process uranium and they can't sell uranium, for example.
So then, okay, I guess that's probably beyond the point. I guess maybe focus like on risk for the project. What do you think the biggest risks are? I know one at least was, what is the actual NPDR content of this monazite going to be? I don't know. Is that sort of just like a speculative thing? They don't really know, or do they know?
No, I don't think they know.
Okay.
I think they don't even know how much really monazite there is. I could be talking wild, but I think it was like a stupid range when I looked. It was like 2 to 12%. It could be anywhere of that. Like basically it's there. We know it's there. We just don't know where and how.
Fair enough. You see any other big risks with the project? Because I mean, it looks like if it
Um,
works, it's a home run, right? But
I
like
mean,
if it's
yeah, it is. It just also, I think it speaks to, like, it's not a big purchase. Like 30 million, probably another 40, 50 million needed in capex to get the mines running, maybe. But it just shows you like this input feed problem isn't really a problem. It's not like monazite is a rare type of, like, it's more available than bastnasite. The whole problem here is that the other two, like Linus and MP, are able to do that in production in-house, where these guys have to rely on external partners, which have basically not been doing their job in terms of delivering the sand. So I think if you look at, we talk a lot about competitive advantages, but their competitive disadvantage is that they're not a miner. And I think this project goes a long step to fixing that. But then you also have the risks of you're opening a mine and you don't really know exactly, how much is there. Is the other problem there.
that makes sense.
There's also
Gotcha.
permitting problems. It's expected to come online late 2023, maybe early 2024, but who knows with mine.
Gotcha.
All right, this is my favorite slide. It looks terrible, but it's fun. All right, so MP, two biggest problems is that one, it uses that bastnasite sand. They just long term, they just can't compete with energy fuel margins. Like bastnasite is more expensive to recover. It's basket value is like 1/3. Like across the board, you just can't compete with margins. What they've been able to compete, like what they've been able to do amazingly is just scale. But you kind of saw if input feed gets solved, energy fuels also has scale. And then the other problem they have is just historical ties with China. They used to have large investor interest from China. They sell their end products. So step 3 to 5, they sell all the China's facilities. So like, if you're the US government and you want to diversify away from China, maybe MP is not the best bet for you. Linus, same thing, Australian company. Maybe if you want everything domestic, maybe not the best thing. But also, I don't really think that's a huge point. It did slow down the authorization of the Texas grant. I don't know if that's through yet, but like, Australia is a pretty close ally. I don't know if that's a huge competitive advantage, but it is a little bit. Like, I'd rather invest in a domestic company than an Australian company.
Yeah, but better than China at the same time. But yeah, definitely not as good as domestic, it seems like.
Yeah. I think the biggest problem with Linus, yes, they're ahead in a lot of areas. They use monazite sand, all that stuff. They have two big problems. One is a lot of their production has not been doing so hot for the last 1 to 2 years because I think, again, same thing with Myanmar, the flooding, I think, impacted a lot of their facilities. And the second problem is just that they have high capex. They're not a uranium guy. They don't really know how to handle, like, they're not someone who has like 30, 40 years experience in uranium. So all they've been doing is like heavy acid leaching of like just to get it safe for like consumption or safe for like take out the uranium, maybe not in the best way, but just acid it out. So basically what that causes is that they need to put a lot more capex into their facilities that Energy Fuels does. So they have this $500 million project plan to do that step, like expand their step 3 facilities. And for Energy Fuels kind of to match that, it will cost them maybe $35 to $40 million. That's your advantage. You have White Mesa, you have the capacity, you can actually, like, Linus is a company that adapted to monazite. Energy Fuels has been perfect for monazite for the last 30 years.
What?
So you don't.
I guess my question is, what made them want to do this now? Is it because, like, yeah, what made them move into rare earths right now?
Uranium market's bad. They moved in.
Fair enough. Gotcha. Do you know, in terms of, I guess, like you said, I mean, it's okay if you don't have an answer to this, but you said Linus doesn't really have the expertise in uranium, and that could be a disadvantage for them. Do you think it could be a disadvantage that Energy Fuels doesn't necessarily have like a expertise in rare earths?
Yeah, it definitely is. But I think, yes, Linus has 4 years more experience, but I also think that's why the last 2 years were really important for Energy Fuels, even though maybe the numbers don't bear that out, is getting that experience, especially like they're the first ones, like they're 4 years later than MP Materials to the industry, and they figured out separation before them. Turns out when you have radioactive scientists, you out quicker than your competition. But yes, that is a concern, I would say. But I don't know. I think they've got a lot of experience over the last 2 years, and if you also look at the valuations, this is what I kind of like about the slide. MP and Linus are basically 5 times the valuation of Energy Fuels. And if you take out Energy Fuels as uranium asset, which we would argue is more than their entire market cap right now, you're basically getting a rare earth business for free. So let's say it doesn't work out as well as you're saying, right? Maybe the Bahia project doesn't turn out as well, or maybe they have some problems with CapEx, they have to increase more than expected, or whatever it is, you're getting this business for free. And for MP or Linus, yeah, it's a much more polished business. It's much more like production's proven out. You're paying 5 billion for it. And long term, like if everyone executes well, Energy Fuels is the most valuable business and you're getting it for free.
That makes sense. It almost makes me want to do a little like long short thing, go long on energy and maybe short Linus or something, little hedge going on.
I just wouldn't, because I just think rare earths is going to be such a valuable like thing in the future that I think all companies are going to do well. I just think Energy Fuel is going to have the most explosive growth. Because what is the growth left in Linus or MP? Really, you have to bet on additional CapEx projects, like working out like $500 million of CapEx for Linus. MP's kind of hit capacity. They have to increase their CapEx, increase their capacity. Energy Fuels, it's a much more like, can they get sand? That's their upside versus Linus is like, can they build out this $500 million project and like make significant gains on it, which is a lot harder to sell than Energy Fuels getting sand.
That makes sense.
We touched on the valuation, by the way, and we'll go into that in the last slide. So
I'm excited that, dude. I looked at that valuation. That's gonna be a doozy to get through.
Yeah, we'll skip through this. It's not that important, but it's just basically how we think their sand is going to scale. Biggest thing is that Bahia project in 2024. We predicted the like Q4 2024, which is basically a year after when it's supposed to come online, but like supposed to never works in mining. So
Fair enough.
this touches on the byproduct uranium, that $33 million number in the bottom right corner. I know you were mentioning that earlier, Logan.
Yeah, so like that final, let's say 2025, which is kind of like, you know, still a year that we can predict with decent guidance in terms of if Bahia comes online. That's 300,000 tons of uranium, which I think is 3 times the current uranium production. That's huge.
And that's just uranium from the sand inputs, not from their own mines.
Yep.
Great.
Love it.
As a byproduct of doing the whole rare earth process.
Gotcha.
Yep. So next slide. This is multiple stuff. We give a slight premium to Energy Fuels just because basket value, and then EV over reserves, but kind of think it should be trading more to that Cameco number because, you know, they're the only ones that are producing, like Cameco. The other two aren't producing. Does that make sense, or do you want me to go into depth about any of that?
I think probably for the purpose of time, we should probably just get to the overall valuation. But is that just sort of like EV to their current reserves, like what they own? And yeah, that makes sense.
All right, next slide. All right, biggest thing here, you just take the uranium business plus their cash position and their metal deposits, and you get a price around $7, which is like higher than their current valuation. So you get this RE business for free. Is that pitch right there? That we stressed this, maybe they didn't get it, but at the end of the day, we believe in both sides of the business, but if you just value them like any other uranium miner out in the business, they're trading at fair value.
Do you have that valuation in the appendix somewhere, just out of curiosity? Or are you just sort of using comps for the like just the core uranium business? Or are you sort of looking at comps there?
We have an appendix. Can you go down to that, Carson?
Yeah. Oh boy.
I'd just be curious. Yeah, no, I was looking through this and I was like, oh my God, they're gonna have to walk me through this.
It's right here. It's basically like it's just a multiple based on reserves.
Yep, gotcha. And so I guess
go ahead.
The question at this point is, are they essentially just trading in line with their like other uranium comps, completely ignoring rare earths?
Yep.
Pretty much.
I think you can just here's what I'll say, the politically correct answer. I think you can justify their entire valuation just based on the uranium business.
That makes sense, though. I think that's interesting because not only, like you said, you do have sort of like a speculative play on the rare earths, but at the same time, you have a limited downside just because you have that core uranium business. That's what's being valued at right there.
I think I'll say it another way too. If you take out the RE component, I would still buy this company because I'm a big believer in uranium companies,
Mhm.
and it's as fairly priced as any other.
So I guess then, we're kind of at the end here. My question would be for you to like, for someone to invest in energy fuels, like what do they need to believe is going to happen? Like you said, you're a believer in uranium. Like
Yeah.
what are sort of like some of the key things that they have to like buy into for it to be a good investment?
Sure. I think number one is that you believe that the spot price is going to continue, or that they're going to continue inking long-term contracts in the uranium business. Like we keep talking about, yeah, this provides downside protection, but it's only if you ever want to even be closely related to uranium. There's some people, probably maybe like most people, I would say, who hear uranium and they run the other way. So you have to be familiar enough with the business. You have to believe that the business is going to increase, which we do, or you at least have to believe that, like, I don't know what else can really go much wrong for uranium in terms of spot price, but you have to believe that, the business is going to exist for the next 10, 20 years. And then the RE side is just, can they increase production? Like we talked about, can they get the Bahia project online? Can they get the sand input? Is their process going to fall apart with higher scale? Which I don't know why it would, but maybe you're doubting that. So I'd say you have to buy that they can increase production on the RE side. On the uranium side, you have to buy that they're going to continue inking long-term contracts,
Love it.
or be able to sell their Alta Mesa, like be able to sell that like stuff off.
I guess that's a good point. I think that's like another thing that provides downside protection. Like if you had I think Alta Mesa valued at 120 million, I can't imagine, being the sole processor of uranium products in the United States. I imagine that valuation could be pretty hefty as well.
Yeah.
I guess
I don't know
Yeah,
the
go.
exact number. Carson, what value do we put on Alta Mesa before the sale? Like it was ridiculously low.
So for Alta Mesa, in their investor report, in their IR report when they sold it, they said it was around 6 to 12 million total.
Yeah. So
Pretty
So
good return.
we significantly undervalued the uranium asset, is what we're trying to say with the Alta Mesa. Like the sale was multiples above what we predicted in our valuation.
Now, is that because markets are just, pricing in like an increased spot price in the future that production is going to start happening here soon?
100%. Because I love the uranium thesis. Like I love macro theses. The uranium thesis is beautiful in terms of supply and demand. Like there's a 65 million pound difference between supply of 135 million, demand of 200 million pounds. You have trusts like Spot that are buying like 60 to 70 million pounds a year off the spot market. You have underfeeding going into overfeeding, which is another 50 million pounds off the market. You just have a bunch of supply leaving. You have demand that's continuing to grow because, and everyone's reevaluating the energy portfolios. Like supply demand is one of the best setups I've seen. The only question there is just how much is left in the spot market, and no one really knows because it's a very complicated industry. You just have to hope at some point, like whether it takes 2 years, 3 years, or even takes 1 month, at some point it's going to dry up and people are going to have to start contracting, which we've kind of already seen 3 contracts already for energy fuels.
Yeah, that makes a lot of sense. I like the fact that, you can get into energy fuels if you're not entirely in for uranium, but you like the rare earth thesis. And also if you're not completely sold on the rare earth thesis, you have like the uranium thesis to back up on.
Right.
I think that's a really interesting aspect. One last risk that I just remembered that I want to think about. Do you have a thesis on their share dilution recently?
Yeah.
And where do you kind of see that going?
I just don't think it's going to be needed in the future. I'd rather, like, a company like this, especially with how financing is working in the markets and interest rates, I'd rather them dilute than take on debt at stupid valuations or stupid rates because they're a mining company without much revenues, right? So I'd rather them dilute, and I just don't think they have 250 million, which is like what 1/4 of their right now market cap. They have 1/4 of their market cap in cash around.
Because of that
Yeah,
sale.
virtually no debt.
Oh, well, what they had 130 million before that. Now they have like 250. So like they have enough cash where I don't know if it would make sense to dilute unless they're just diluting for the sake of diluting.
Fair enough. Hopefully they don't do that.
Yeah.
Anything else you guys want to add before we sort of wrap up here? I think you guys did a good job of covering most of it, but anything else?
I guess the one-liner to anyone who doesn't understand like the business, the rare earths business or the uranium business would be you buy energy fuels because, so one thing I asked myself and a lot of us or my teammates asked ourselves was, why do we buy energy fuels today at the current price, right? And the main thing is, one, you're getting the uranium business, as Abhi said, for free. At around $7 is $6 to $7 is the uranium business. That's what we valued it at. Plus, so that's limited downside, right? Plus, you have an upside of your rare earth business, which is, as we said, 14, 16 over the next, 4 to 5 years. So the main thesis that we tried to convey to the judges and everyone at the stock pitch was that you're getting a uranium business for free with a growth engine that has a long runway of 10 to 20 to 30 years, as Abhi mentioned, for its uranium business. So you have limited downside with a massive upside potential.
Yeah, and just like we've been saying this a lot, so I'll just like wrap it up. But again, the other competitors are 5 times as much value wise. I would rather take this company in 10 years. Like if I just had to blindly pick one company out of those 3, it'd be this in 10 years in the rare earth space. I just don't see why the market's not placing any value on this business. Even if you don't think it's worth 5 billion, at least it's worth a couple.
That's fair looking at those valuations. I think that was a really great way to wrap it up there. That was a really good sort of overall thesis there. Yeah, well, thank you guys for coming on. I think you guys did an awesome job of sort of explaining this. I really like the thesis. I think the listeners will too. So I appreciate you guys, taking your winter break to come on here and talk about energy fuels. Yeah, if you guys ever want to come on again, if you guys have any other ideas to pitch, you guys are obviously all really great investors. I'd love to have you guys on again. But yeah, once again, thank you guys for coming on and hope you guys all have a really great winter break.